Is this all about geopolitics and inflation then?
Yes. So what we have in the market, you have two conflicting forces, I would say, especially on the interest rate. You have the Ukraine tension, lower yield, and you have the Fed fighting inflation, higher yield. And today we are clearly in a risk-off environment. So we have the Ukraine tension are taking the lead. And then we have to look at what's going to happen more on the medium term. And then interest rate, and also maybe at some stage further down the road, what's happening in China and whether we see some growth stabilizing. So which are, I think, going to be the two major events going beyond the geopolitics.
How does the energy inflation upside risk that we're seeing right now affect Asian equities, given that many of these nations are energy importers?
Yes. So, well, what we find is that on the different channel for the Asian economies, and whether you look at the trade, we look at the energy, the impact is relatively limited. Asia. Unlike the US or Europe, doesn't have such a big inflation problem, so you tend to have a lower base. But I would say the impact would be more a kind of indirect impact through the financial market and through the risk premium in the case of the equity market.
And of course, all of this overshadowing concerns of a renewed crackdown in China that's been driving risk assets in that part of the world lower. Are we in for another round of some pretty harsh measures from the government there?
The simple answer is I don't know, but there are a few things that we can look at. There will be the National People's Congress gathering later in the coming weeks on the 5th of March. What's going to be discussed in terms of regulation, internet regulation, is going to be of the utmost importance. And then compared to where you were last summer, there are two elements. One is we have a better understanding of the framework of the policymaker and of the regulator. So what's going to be targeted, what's going to be important. And number two, from a pure market point of view, you have the valuation which have come down a lot, so which are incorporating some lower margin. And number two, the positioning of the market, which has changed massively, with investor becoming much more underweighted that they could be in the previous summer. So these two elements are in some way mitigating the negative impact that you could see from further tightening in the regulation.
You talk about the major downside risk remaining rates, the market starting to price in the Fed terminal rates above 2.5%. We see the moving forward of expectations for the first rate hike as well from the Fed with the acceleration of timing. How do you position your portfolio for that kind of slowdown risk?
Yeah, we have a portfolio which has been positioned for a normalization in interest rates. So that means that we have a five increase in our scenario in 2022, and it means that at this stage we are not seeing any recession. And it could change looking at the data, but it's not something that we are seeing at this stage. So it means that it is, in our opinion, too early to go fully defensive. So in the global portfolio, last June, we made the decision to move from a dynamic to a balanced portfolio, to diversify away from the US equity into lower valued equity market, and looking at Asia, looking at China. But it's just too early at the moment to go full defensive, as long as we are not seeing the market starting to be more worried and say, okay, the terminal rate is not going to be 2.5, but it's going to be 3%, or it's going to be above. And this is where we would become more defensive in the global allocation of risk assets.